Hi, welcome to this week's edition of the Stockscores Market Minutes for July 20th, 2015. This week I want to talk about something that's, I think, fairly timely, and that is pullbacks to trend lines. In a long-term upward trend, you often get these shorter counter-trend pullbacks. They're these short corrections that take price back to the long-term upward trend line. Now, short-term traders tend to be shaken out of positions. Those nervous shareholders tend to sell because the weakness feels like it could get a lot worse. What that does is it cleanses the market of those short-term sellers. And the result is that this selling supply becomes exhausted. And there's often a quick bounce back rally as demand then overpowers supply. Here's a chart of the S&P 500. You can see that we had some selling pressure from the middle of June until the middle of July. It came back to the long-term upward trend line. Now that long-term upward trend line that I've drawn in green shows up more clearly on the 3-year weekly chart, which we'll be looking at in a moment. The price also fell to the horizontal line of support at 204 on the SPY. And it was at that point, when the issues in Greece were resolved, that the market made a very quick snapback rally. You can see that in the matter of just this week, the market came back to nearly its old highs, and we'll see if it gets to its old highs next week. All of that came because the pessimism that surrounded what was happening in Greece and the resulting pullback to the long-term upward trend line, it cleansed the market of those sellers, and then the buyers came back to snap up bargains and put the market back into its long-term upward trend. So here we can see it on the intraday chart going back the last 30 days. There you can see Monday's performance where we gapped up after some resolution happened in Greece, and we just had great follow-through taking the market back to that horizontal line of resistance on the intraday chart. There's a little bit higher line of resistance on the daily chart. You can see here on the weekly going back 3 years that we're just about at that long-term resistance. So essentially what's happened this week is the market has resumed its long-term upward trend. We're still stuck in that sideways trading pattern that we've been in for the last 7 or 8 months. And so I don't think the market is out of the woods by any means. We want to see if it can break through that long-term line of resistance, the red line. My sense is that next week we'll get stuck there, but time will tell. So what's happened though is good for the market if you're a buyer. It's good for the market if you're a holder of shares, particularly US stocks, because the buyers have retained control, really the control that they've held since 2011. And of course in 2011 we had a little bit of a more substantial pullback, but this long-term upward trend really started in 2009. Here's the Russell 2000. It also resumed its upward trend, probably not as strong as the overall market rebounded, so money didn't go jumping back into small caps quite the same way as it went into the large caps this week, but it's still a healthy chart. It's one that is in an upward trend. It recently broke resistance, which I drew in red, and that became support, which I transitioned into green at 120 on the IWM. Positive market here. Here's a chart of the TSX 60 going back 1 month, 60-minute interval. You can see that the downward trend that we had been locked in for a few weeks was broken on Wednesday, and looks like the market should resume its strength. It's a little bit of a difficult market in Canada because we've got the commodity sectors which have done very poorly. Oil got beat up last week. Gold really got beat up last week as the US dollar rose. And so you've kind of got a tale of two markets. You've got the overall TSX, which did okay. It was really dragged down or held back by weakness in the commodity sector. Now oil is coming to some support. We'll talk about that in a moment. So we could see a little bit more of a resumption in this upward trend for the TSX if oil can make a bounce. I'll talk about that in just a second. Here is a chart of the TSX 60 ETF going back 3 years on a weekly basis. You can see that it's trying to break its pullback line on that weekly chart. I think it'll happen. I think we're going to move back to the highs, but don't get too excited because we're still stuck in that sideways trading range that we've been in since last fall, and it's going to take a little bit of work to get through that red line of resistance. TSX Venture really got beat up this week, moving to new lows. Again, the heavy weighting of oil and of gold and mining names dragging this market lower, and I've said it for a long time, you want to avoid this market, at least the commodity sector of that market, which is about 65% of the TSX Venture, because that sector is really suffering right now. Treasuries had a little bit of a rally this week. They're oversold, and I think that they will rally back to that red downward trend line. That means interest rates will go down a little bit in the short term, but longer term, we're still in that pullback phase, and so I'm still relatively pessimistic on bond prices, which means interest rates looking out longer than a few weeks should be higher. But in the short term, I think you will see a bounce back in treasuries. US dollar, this is a real important chart this week because it's breaking its flag pattern. That flag pattern has been in place for 4 months. I've drawn that in red and green there. And we broke the downward pullback line, the red line, and that points to a higher US dollar. So again, that's a higher US dollar relative to global currencies. It doesn't necessarily mean specific to every currency. This is a US dollar index, heavily weighted toward the euro and the Japanese yen, but certainly the Canadian dollar showed a lot of weakness this week as well. And it's all about the US dollar showing more strength, and I think that will continue in the weeks ahead. Gold breaking to new lows, strength in the US dollar certainly hurts gold. I think gold is going lower. I've been a bear on gold for a long time, and I continue to be that way. Look for lower prices in gold. Oil, weak also because of that weakness in the strength in the US dollar. But it's also got pretty good support there at the green line that I've drawn, so I think it could bounce. That would be supportive for Canadian stocks. We'll see if it happens. But if the US dollar is going to continue to be strong, I think that's bearish for oil. And so I do recommend some caution. I think we could see a bounce back, short-term bounce back in oil in the next 1 or 2 weeks. But until that red pessimism line, that downward trend line there is broken, I don't want you to get too optimistic about energy. And the VIX moved to new lows this week after that pickup in volatility and the pickup in volume. That was sort of that fear coming into the market with Greece. Once that got resolved, the VIX went right down to new lows, and again, fear is not a factor in the market. So I remained neutral on both Canadian and US stocks, but I've upped my short-term rating from bearish to neutral because we bounced back this week. And I remain bearish on gold, both long and short term. Oil, bearish long and short term. Oil doesn't look as bad as gold because it does have some support that it can bounce off of, but certainly it's a trader's market in oil. You don't want to be too optimistic just yet until that downward trend line is broken. With Greek issues resolved, at least for the short term, the market rebounded this week with a quick move higher. Resistance has not been broken, so I remain neutral on these markets until that can happen. Strength in the US dollar is hurting gold and oil. Gold looks particularly weak, while oil may try to hold its recent lows. And as I said, fear is not a factor in the market right now. Well, that has been the Stockscores Market Minutes for July 20th, 2015. Have a great week in the market and trade well.